Americans are generous people. From 2009 to 2018, the US ranked #1 as the most generous country in the world. And in 2022, America was still the third most generous country. In fact, over $319 billion came from regular people just like you and me that year. And this is driving positive change all over the world. As a certified financial planner, I help our clients give in the most tax-efficient ways possible. And there are many strategies to choose from. So if you're curious about how to weave charitable giving into your retirement plan, then this is the video for you. Hi, I'm Julia Lemke, Certified Financial Planner and Managing Director at URS Advisory. Every day I help people retire when they want and how they want. And giving to charity tax efficiently can be a huge part of a successful retirement and legacy plan. Today, I'm going to share the tax benefits of charitable giving, give you the best strategies to use this year, and review 3 case studies that illustrate how we can actually use these strategies. I will note that we are in an election year, so laws could absolutely change, but let's review what we can do this year to make the most of our philanthropic pursuits. Typically, advisors discuss charitable giving toward the end of the year, but I actually think it's useful to get this information out as early as possible so that you have time to decide how much to gift and to whom to give and actually execute your plan. There are currently 3 tax-efficient ways to give, and the first is using the charitable deduction limits. If you itemize your deductions, the annual deduction limit for gifts to public charities, including donor-advised funds, is up to 30% of your adjusted gross income for donations of non-cash assets held more than 1 year, aka investments, and up to 60% of AGI for cash donations. If your 2024 charitable deduction amount exceeds these AGI limits, you can carry the excess amount forward for up to 5 additional tax years, subject to the AGI limits in each year. So appreciated non-cash assets in English are just investments. Stocks, bonds, ETFs, mutual funds that are held in your brokerage account that you've held for at least 1 year and a day that have gone up in value. There are 2 benefits to donating these assets as opposed to cash. And those are that #1, you can eliminate the capital gains tax you would incur if you sold the assets and then donated the proceeds. And 2, if you itemize, you can claim a fair market value charitable deduction for the tax year in which the gift is made. The second tax strategy is using a qualified charitable distribution from your traditional or pretax IRA. And by the way, it has to be an IRA. So I just got this question the other day, and the answer I think is really important to share. The strategy I'm about to tell you about is only able to be used with individual retirement accounts or IRAs. So if you have a 401k that's a pretax 403b, defined benefit plan, you cannot use this strategy. But if you have a pretax IRA and you're at least 70 and a half or older, you can instruct your IRA administrator to send up to $105,000 in 2024 to 1 or more operating charities, excluding donor-advised funds, tax-free. So instead of donating cash or stock, you can spend down your least valuable or your pre-tax accounts before you have to start pulling required minimum distributions. Also, once you start to pull your RMDs, you can send all or a portion up to the annual limit to your charities of choice and avoid paying ordinary income tax on your withdrawal. A quick tip for this though, calculate your RMD first and then send your qualified charitable distributions out before pulling your required minimum distribution so that you're actually directly reducing the amount you're required to pull and pay tax on. I love this strategy because it allows you to preserve your more valuable accounts in retirement, your brokerage accounts and your Roth accounts, while spending down your pre-tax accounts for a great cause. By the way, you can use this strategy whether you itemize or take the standard deduction. So let's go over 3 common situations and their charitable giving solutions. The first situation is, let's say your stock has gone way up since you bought it. What should you do with it? Elizabeth purchased 2,000 shares of XYZ stock 5 years ago at $5 per share. The stock has appreciated to $50 per share and become an oversized position in her portfolio. She wants to use 1,000 of these shares to give to charity this year. She could, of course, sell the shares, pay capital gains tax on the appreciation, and then donate the after-tax proceeds to a donor-advised fund or other public charity as shown in option 1. However, by donating the stock directly to the charity and eliminating the capital gains tax as shown in option 2, she can actually increase the amount available for charity and save in additional tax savings for her. You can see this in the chart that by gifting appreciated stock, she's able to donate an additional $6,750 to the charity and save $8,370 in taxes for the year. That is powerful. Second situation. My itemized deductions are below the standard deduction, so itemizing doesn't make sense. Should I make a charitable gift this year if I can't get the tax deduction? Many people who are charitably inclined find themselves stuck between taking the standard deduction or itemizing. The solution is to bunch 2 years of charitable contributions into 1 year, itemizing your deductions for that year and then taking the standard deduction the next year. Rachel and Mark are a married couple with no children. They have $23,000 of itemized deductions, including $10,000 in donations to a donor-advised fund. By the way, I've made a couple references to donor-advised funds, and these are charitable investment accounts for the sole purpose of supporting your causes. When you contribute cash, securities, or other assets into a donor-advised fund, you are generally eligible to take an immediate tax deduction. Then those funds are invested for tax-free growth while allowing you to support charities on your timetable. This is a perfect solution for someone who wants to gift appreciated assets or cash tax-free, but wants time to decide exactly where the funds go and to what amount. Maybe you want to gift multiple organizations, and doing separate individual gifts is just too labor intensive. Okay, back to Rachel and Mark. Because their total deduction amount of $23,000 is below the standard deduction amounts of $27,700 for 2023 and $29,200 for 2024, Rachel and Mark could either take the standard deduction each year and over 2 years claim a total of $56,900 in standard deductions, as shown in option 1, or they could take a tax-smart approach and bunch 2 years of donations into 1 year, as shown in option 2, and end up with an overall deduction of $62,200 for the 2 years, using the itemized deduction the year they bunch their donations and the standard deduction the next year. This gives them $5,300 of additional tax deductions. Let's review a qualified charitable distribution scenario. Let's say your required minimum distribution is subject to it and you just don't need any more income this year and you don't want to be pushed into a higher tax bracket. What are your options? Well, a charitably inclined client can satisfy all or a portion of their traditional retirement account RMD by giving through a qualified charitable distribution or QCD. The gift can be sent to one or multiple charities and is not taxable to the client. John is 75 and has a traditional IRA worth $1,050,000, resulting in a projected RMD of $42,683 for 2024. John will already have $80,000 of income, which is plenty for him in 2024, and he doesn't want the excess income or taxes, so he would like to donate this amount to charity. He could 1, take the RMD, increasing his taxable income to $122,683, and then use the $42,683 to donate to a charity and claim that deduction when he itemizes, as we can see in option 1. Or he could use a qualified charitable distribution in the amount of $42,683 to charity. This erases the extra $42,683 in taxable income and allows him to take the standard deduction as illustrated in option 2. Using a qualified charitable distribution lowers John's taxable income by $16,550. Okay, folks, we've reviewed the 3 best strategies for charitable giving, using the charitable deduction limits, donating stock, and qualified charitable distributions, as well as 3 case studies that illustrate these strategies. If you found this video helpful, please be sure to like and subscribe to my channel and share it with somebody you care about. Thanks for watching and see you next time.